we won't have to do that because I've been covering everything pretty well. So tonight what I want to cover is we'll do the suggested assignment from last week. Several people sent it in, and folks did a pretty good job on that overall. In fact, I saw a couple of people actually found things that I had never seen in there. But so that's good. That's a plus. That's a plus. That means you're doing well with this. So we'll do that. Then I want to talk a little bit about another important price behavior, which is called range contraction, range expansion. We'll talk about a little bit of the history of that and how to identify it and what it means to us as traders, because it's a very useful tool or concept that we can then turn into a tool. Then I want to move from there into trade setups. And we started off, if you think about it, we started off talking about market structure and trend lines and waves to highlight that market structure. And then we went into a few bar patterns, common bar patterns within the context of Wyckoff. We talked about signs of strength and signs of weakness in the market. But we talked also about pulling those together where they count. And that's going to be in the context of trend lines and wave structure, or the market structure. All right? We talked about some principles of price behavior. We're going to talk a little bit more about momentum tonight in the idea in range contraction, range expansion. And then we talked about a framework of or a conceptual map of the market. And now we start to pull all of this together over the next two sessions, tonight and tomorrow, through trade setups. Okay? And in the packet, or in the email that I sent out tonight, there is a separate PDF file that has a little chart or format, if you will, for a suggested format for laying out your trade setup criteria. And I think it's helpful. People find it very helpful, and I think you will as well. And so I'll discuss that tonight, what goes into a trade setup. And it's not just if price does X, then we do Y. It's not about that at all. It's a little more detailed than that. We'll talk about that. And then I will talk about two trade setups. First, we'll start with a conceptual map of each trade setup, and then I'm going to give you detailed examples of the setups. I think it's a good idea to put your head up on the conceptual level first and then do the details of the setups. And I'll show you several examples of each of the trade setups. And then at the end of each one, I will highlight the trade criteria used. We'll define that, and we'll put that into the format, the suggested format that I have for your trade setups. Okay, so we'll show you how to set up good trade setups. They're like a little mini plan. We'll talk about that. All right, any questions about what we're going to cover tonight or what we're going to do tonight, or on anything that we've done so far? And as you may be typing, let me just encourage you, since next week is the last week, if there are any questions that you have, then start to formulate them and be sure to ask them next week so we don't miss the opportunity to answer them, okay? And I know a couple of people sent in some material this week, and I haven't replied yet, but I will before the end of the week. I got a little bit behind, and also people sent in things a little bit late, so try to get them in by Sunday at the latest, if you would. It's easier then for me to take a look at them. Although this week I was down in New York City for most of the weekend and didn't really have a chance to do everything that I needed to do. Okay, Here is the suggested assignment that I had put at the end of the set of slides last week. And it's all about combining indications of strength and weakness with structure. And so let's go through this. And we can do it a little bit in some detail. We've got time for that. But as we go through it, we can see that at 1 here, we break out above the high of this level here, and we come back and we test it in here. This is a little test, right? We get into a narrow range day here, an inside day that we're going to talk about tonight, and then that starts to push the market up. The narrow range days, I think we've talked a little bit about them, although maybe it was a different class that I talked about that. I'm not sure. But they give, and I'll review this again in a few minutes, but they give us a little bit of equilibrium, and you can see in this bar here in particular that buyers and sellers just come right into the middle of a little trading range, which is inside the previous bar. And there's strength in the market, and the market rallies up from there and continues to go up, respecting this trend line all the way up. And then we get up into here. Now, what do people notice about this area in here? What's happening in here? There are 3 basic things going on that we want to be aware of. What are they when we're approaching this? We have shortening of the thrust. Very good, Lars. That's right. You can see it in the price bars. And I drew, excuse me, I drew this little line in here to highlight that shortening of the thrust. What else have we got up here? Right, we're overbought in the trend channel, right? We've been cooking along here. This is a daily chart. We've been going along very nicely, and we're pretty high up there. We got a little overbought here, but it resolved itself nicely. Here we get overbought, and we are seeing shortening of the thrust coming in. And then last, we have an up thrust. Yep, exactly right, Walter. You could call it a top reversal where the first bar goes up and the second bar goes down, or just an up thrust. It doesn't really matter what you call it. But just prior to that, we break the uptrend channel, right? So 3 things going on, actually 4 things. We break this uptrend channel, the demand line here. So it indicates that supply is getting stronger and demand is getting weaker. Weaker in terms of the shortening of the thrust, weaker in terms of being able to hold the defensive line the way it was doing all the way up here on this trend line, and weaker, of course, with the up thrust, where it was unable on a breakout to continue, and we have failure to follow through. Okay, right, and it stands as the up wave is long, and it is long, and it's probably due for a pullback. We could have said that in here, though, so it's not a great criterion for saying that we're due for a pullback, because it was pretty long in here as well. Trends have a funny habit of going on longer than you expect them to. And a lot of people like to try to buy tops and sell bottoms, or sell tops and buy bottoms. And actually what they're doing is they're buying tops and selling the bottom. And that's not what you really want to be doing. You want to let things line up. That's the whole theme of, or one of the themes of this course, is to be able to tell a story. Okay? So we break down here. We break down through support, and you see that there's this S/D. That means supply overcoming demand. Another way to say it is ease of movement to the downside. And I'll just ease of movement down. Okay? Supply is in control. So in here, a nice trade. We drop down, we rally back up, we come back down again, and what's B? What is B for everyone here? In our conceptual map of the market, what would B be? Yeah, test, right. We come down and we test this level. Now it's kind of hard to take a trade in here because we're holding a little bit of a higher high, but we note that there's some strength now in this area. A, because we made support here, and B, because we've come down and tested it. And then that becomes important a little bit later. We rally back up, and we come back up to the high of A, and notice that we had a lower high in here earlier. And we've had a couple of indications of supply overcoming demand. One here and one here. So we know that this area, just in general, has some supply to it. And what happens up here at C? What occurs there? Another upthrust, right? We rally up. It's kind of a weak rally up. We see that the first bar closes in the middle. The next bar comes right down and closes underneath the last resistance level. And it kind of was going up to A and also to this second resistance level. So it upthrusted two levels at once. Okay. Could we say that it's a regular upthrust and a hidden upthrust? This is more the regular upthrust here. This would be more of a hidden upthrust, one that is more obvious on a smaller time frame over here. But you know, you don't have to get too technical about those. Just recognize that there's a failure to follow through to the upside. Failure to follow through to the upside. In neither case was there. We have a high, so that provides some resistance. And when we try to push up above it, we can't do it. And this is just a little bit of a bigger one than this one. All right, then we come down, and what happens down here? Tell me what's going on at D here. There's a spring on somewhat lower volume, okay. Right, we try to go down here and then we rally back up. What else is going on? And there's a clustering of closes, yeah. It's a test of support, right. Kind of goes through the support. But don't we see some shortening of the thrust in here as well? If you looked at this on maybe an hourly chart, I'll bet you dollars to donuts you would see 1, 2, 3 pushes down. Right? They would be nice and symmetrical coming down here. Everybody see that? See the story that gets put together here? Shortening of the thrust, a spring, clustering of closes, all of that. Right? And what does the market do? It does a fabulous job of this spring. This is what we kind of live for, those of us who trade this pattern. And this happens to be a pretty good one because we've come down here, as I said before, had support establish itself in here. Then we test that support. And now, just like on the conceptual map of the market, you have a spring and we have failure to follow through to the downside. That doesn't happen. So if we're not going down, and so here's here's demand, I should say, not supply, demand over supply, right? We rally up nicely. All right, so tell me what's going on at E here. And that's right, there's good volume coming in on the up bars, on the rally bars. That's right. Tell me what's going on here at E. Up thrust on declining volume, right? We're declining on that volume. What else is happening here? What's the story? An outside reversal plus an up thrust, yep. What's the story here? Do we have shortening of the thrust up here as well? I would say we do. We push up to A, we push up a little higher to C, and we push up here and we spend some time trying to go up. And we can't do it. Failure to follow through to the upside on shortening of the thrust in a known area of significant resistance. We've seen it twice now, really 3 times. Put a small R in here because it made a lower high, right? And the volume does come down, that's right. And I think E, the volume on E is right here, and that's this volume here, and it shows that supply is coming in under control. If you're concerned about whether this might be absorption, which is always the concern when we're looking at an upthrust, because the market's either going to upthrust and come down, or it's going to absorb and hang. So typically, if it does absorb and hang, you'll have an opportunity to get out, but you really don't see a bar like E in absorption, okay? Where it rallies up and then comes back down again. You'll see different kinds of bars than that, but not that kind of a bar. So again, we see supply overcoming demand, this ease of movement idea to the downside. We find support down here, and we rally up. What happens at F? What happens at F? A little testing of the ice, right? This was support here, and now it's turned into resistance. Very good. What else is going on? Asta, that's enough. That's enough. That's my dog. We got a little clustering of closes indicating that it's higher to go up. Don't we have shortening of the thrust in here as well? And we have an upthrust, right? Or a hidden upthrust. This is what my definition of a hidden upthrust would be. We are in this little area here where it pokes up and then comes right back down again. And we have supply overcoming demand. So look, this is the way I like to think about a trade setup in a trending market early on. I don't always necessarily get an opportunity to buy or sell the high, but now I've got ease of movement to the downside. I have shortening of the thrust. I have inability to rally up, and I have a hidden upthrust or an upthrust. And again, it doesn't really matter what you call it, just as long as you can recognize it. All in a known supply area, because we know that this was big supply coming in. Okay, do you see how I'm crafting this? How I'm crafting these trade setups? That's where we're leading to. We've been leading to this all the last couple of months, or the last 6 weeks. We want to be able to build enough of a story in the structure of the market, in the background conditions of the market, to support a trade, and not just go in because the bar looks like it's a hammer, or the bar looks like it's a doji, or a bullish engulfing pattern. You know, that kind of stuff is not going to get you anywhere. When you can begin to pull together what's going on in the structure of the market. Here we had 1, 2, 3 times to try to go higher and fail to do it. We have an upthrust. Supply comes in. We try to rally back up, and we're just pumping in here, churning. And in the local area here, we have shortening of the thrust and a hidden upthrust. My goodness, what else would you want for a short trade, right? What else would you want for a short trade? All right, couple of questions. I've seen the shortening of the thrust so much in the past that's easy to overlook them. Okay. you are looking for a you want to think about having a story, a Wyckoff story here. You want to think about having 2, 3, or 4 pieces of background or structural information that gives you sort of the go-ahead to take a trade. Okay. Is this an ABC? ABC, ABC. Maybe on a smaller time frame. Not really here. Kind of. It's an Elliott wave idea. You've got an A. It comes all the way back down and makes a lower low. It's kind of a ABC flat, I guess, and then a C. But yeah, it is. Before they were defined. Yeah. Okay, good, Lars. That's good. So what happens? We get a lovely response, as we should with all of this in the background, right? With all these components in the background, we should get a good response to the downside. And we do. We break down to a new leg lower. Notice where we're stopping, right here on this support line. And obviously this becomes a bit of an access line, where it kept the market down, pushed the market up, pushed the market up, holding the market now, driving it, but it fails. We come up to ice in here. We have this is going to be a hidden up thrust. This bar here would be a hidden up thrust on a smaller time frame, I'm sure. Even on this time frame, you can draw, I didn't draw this line in, but you could do that, and shows that it's a hidden up thrust. We follow it with a no demand bar inside the range of the previous bar. Lovely. Very nice. Just means that there's no ability to rally this. And it comes down, and again we have supply overcoming demand. Okay? All right, tell me what's happening at H and I here. What's going on down here, and why would we be interested in taking a trade? I think I'm coming down. Some climactic action, right? Good, Trevor. Excellent. Excellent observation. Remember what we said about climactic action. This is a pretty good rundown as it is. Normally we see them more around 45-degree angles, and this is probably about, 60. And then it goes straight down from there, and it drops right through the support level. And it just feels like it is going to be, we're boring a hole from New York to Beijing here. And some of the telltale signs of the climactic action is we get way oversold in the trend channel, which we do. Big volume comes in, which it does, and then we see support starting to hold in here, right? So then we see shortening of the thrust occurring here. We're unable to go down lower. Let me erase this. And I would again bet you dollars to donut. Well, not quite, but you would have sort of a 1, 2, 3 here as well, 3 pushes. And then we have a spring, don't we? We dip underneath and then rally back up, and then it gets tested in here. So harder probably to take this trade than the other ones. These springs are tough sometimes, especially on something like this, but they're worthwhile getting to know. I would recommend, there are a couple of different kinds of springs. Well, we can talk a little bit about that in trade setups. This one may be the kind that you don't really want to be taking right away until you get familiar with and a fair amount of experience with springs and you're comfortable with them when we're still in a downtrend. Well, let's go on. We'll talk a little bit more about that as we go on here. All right, so now we rally up, and for, once again we see demand overcoming supply, and we push right up through this resistance level. We've got resistance here, and then the larger resistance at D, and we drive right up through that. So demand now is in control. Buyers are in control. No question about it, right? What's happening at J? What do we see there? Shortening of the thrust, good, right? We do see that. I think we would also see 1, 2, 3 pushes up here, right? We see an up thrust occur, little no demand at the top, and then an up thrust. Now, would we take this trade or not? Would we take this trade or would we not? As a short here. No, because of the demand over supply. Okay. Yeah, we're pushing up, right? So it's probably it's not a high odds trade, this kind of an up thrust. Okay. Let's assume though that we did take it. All right, let's assume that we got in maybe as it was going down or even on the low here of this bar. Let's assume we thought, okay, and our target, of course, is going to be a push below the lows here, right? So we come down here to K, and what happens at K? What occurs here? What occurs at K? Or the bar after K, I guess I should say. Not actually K, but yeah. We spring, right? This is a nice spring. This is a good spring to be thinking about if you're just starting off with springs. Much easier to trade, and you're not going to make as many errors as a spring down here where you're trying to buy in on a falling market. After you get good at them, these become easier, but right in the beginning they're kind of hard. But now if you've got the wind in your sails, right, and meaning that there's ease of movement here, there's a good acceleration or good momentum coming in. This would be new momentum highs in here. You would see that, right, or we should see that, principle of price behavior. So that's one of the reasons why we wouldn't want to take a up thrust here, but let's say we did. So if we did take that and then we saw this spring and start to hold in here and test it in here and certainly again here, but this is really a test in here, we don't want to be short this market any longer, right? So we get out of it here if we did that, and we could reverse if we wanted to. And certainly I didn't draw this line in, but certainly over here we could put a line in and this market dips down and we get another spring here. So, maybe on an hourly chart you would see a spring develop and then rally strongly up. And again, we get demand overcoming supply, that ease of movement up, that acceleration or that impulse or motive wave up. Okay? And we haven't talked about wave structure at all, but we can see that, up wave smaller than down wave larger than up wave, down wave larger than up wave, down wave stays the same, and then we're hoping, because we see the spring and the shortening of the thrust, we're hoping for that bigger up wave. That's what we get here, smaller down wave, but then suddenly the up wave starts to shorten in here. We again get shortening of the thrust at L. Everybody see that okay? Let me just make sure you all see shortening of the thrust there. That's important that you be able to see it and not miss it. So just give me a Y or a yes. Or an okay. All right, good. And as we talked about, we could draw this trend line here. This is the demand line that we draw off of I and K. And we might have had to have adjusted it. We might have drawn it like this to begin with. But when we see K holding and the market's rallying up, then we draw it off of I and K. And so we would put, a parallel up there, but we would be seeing that, gee, it's not happening at all. We're not getting that lift. And as this market starts to come down, what is happening here at L? What's the indication here? What's the sign of weakness that's occurring here? kind of a 2-bar reversal. That's pretty close. That's right. Remember we talked about effort to rally up, and we see the result on the next bar. This is kind of a Tom Williams pattern, that the next bar just wipes out all the buying that's occurred, and probably on high volume as well. So that's that effort versus result on the price bars that we can look at. So we see shortening of the thrust in the waves. Potentially, it'd be hard to see this as it's occurring, but you should certainly be able to see the shortening of the thrust in the price bars here while it's occurring. Then we get this effort versus result. So if you were long from in here somewhere on this spring, you want to exit your long positions, and you could potentially even take a short if you wanted to, or you may wait on that, kind of up to you. But we come down again, supply overcoming demand. The wave structure has now changed. We've made a lower low. What about here? Don't we have a nice little spring at M? What do you think about that? What do you think about a spring here? And Walter says we get a change of momentum to the downside, and most likely what we're seeing, if we look down an oscillator, and certainly we see it here, new momentum lows, right? And right, we don't want to take a spring in a downtrend with all this momentum to the downside. This is dangerous to do. People tend to do this and then say, oh, springs don't work. Context, market structure. Waves are now larger than up waves. Look at how unable this thing is to rally up. We've broken down, making new lows here. Momentum has come into the downside, wide spreads, increase in volume, all of those things. We don't want that. At N, we get another one of those efforts versus result. We try to rally up. It looks like a nice bar to go up, and then it just slams down. I'll go through the rest of this. We get a little oversold at O. Just because we get oversold doesn't mean that this is a place to take a trade. You want to let it develop. We rally up to P. The downtrend line continues to hold in here. We fall back down. But what happens now at Q? What's going on here? Well, no progress is being able to be made to the downside. We get shortening of the thrust. We are again oversold in the trend channel. We're plummeting down here. We're very oversold down here. Tough one, and we also get a small spring in here too as well, right? Tough to take this trade, I think. And again, especially if you're new to springs, very tough to take. That's okay. Let it resolve itself. We rally up. Wave structure changes. Demand overcomes supply. We get some testing going on in here. And actually a little spring. R does dip underneath. This price bar at R does dip underneath and doesn't go lower. And then we go on from there. Okay? Y'all see this? Y'all see how this works? Again, with the emphasis on the background, the emphasis on putting together a small story of strength or weakness, and then looking for the trigger to take a trade. Don't just be jumping into the market or jumping out of the market because you see a upthrust-like bar. Okay, make sure there's something behind it. Laura says you have to make it a real good habit. Yeah, and that's what we're going to talk about next, is making this into a habit. Okay? We'll talk a little bit about that. Well, before we do that, actually, I'll come back to this idea, but we're going to talk about range expansion and contraction before that. But we're going to talk about making this into a habit, this looking at the structure and telling a story in the trade setups, in the format that we'll use. And of course, it requires some work, and trading requires work. This is a skill set that you're learning, and so you need to put the time in on it. You need to put the effort in. All right, just like anything. If you want to be good at tennis or baseball or trading or rock climbing, whatever it is you want to be good at, you have to put the time and effort in. Otherwise, you can listen to me talk, you can listen to any expert talk, go over to, what's that internet channel, TED, the TED Speaking Bureau or whatever it's called. Listen to those guys all day long and it won't make a difference in terms of your knowledge. It'll affect your knowledge a little bit, but not your skills or your abilities. Okay? What I can convey is knowledge, and I can convey a bit on how to develop ability and skill, but the lion's share of that sits in your camp, so to speak. Okay? Yeah, result equals effort. It's sort of the reverse of what we well, it is. It's effort versus result. The more effort you put in, presumably the better results you will have. Okay, so let's talk now a little bit more about price behavior. I think this is a really important element of price behavior. We talked about new momentum coming into the market last week, either to the upside, which we call new momentum highs, or to the downside, which we call new momentum lows. And we said that the odds are very favorable that momentum will, when new momentum comes into the market, it precedes price. And so even though we see a good move to the upside or downside, whichever way the momentum is moving, more price is yet to come in that direction. So we shouldn't be upset that we missed the move. We should be happy to see that new momentum is coming into the market. Okay. Now I'm going to show you how to find momentum. And again, this is not my work. This is the work of a trader who is still trading. I've never met him, but I've read his work, and his work is outstanding. His work is not available anymore on the open market. It's out of print and very difficult to find, and then very expensive if you do find it. But it is available in article format. When he first published this book, and I want to say the late 80s or early 90s, I think it was called Short-Term Price Patterns, Trading Short-Term Price Pattern. It was a long name. He also did a series of articles for the Technical Analysis of Stocks and Commodities magazine, and they are available. You can look it up on the web, and I would encourage you to get his articles because they are very, very good, and they very good insight. And the fellow's name, by the way, who did this is Toby Crable. Toby Crable, and he researched this very thoroughly and showed, in fact, that when we think about volatility being a marker of the cycles in the market, right? When the cycles are contracting, volatility gets small or low, and when the cycles are expanding, either to the upside or downside, then the volatility gets high. Well, ranges, price bar ranges, are a measure of volatility, right? Remember what we said in the very first session, or one of the early sessions anyway, that volume certainly is a measure of activity, but also the price bar itself is a measure of activity. So when we see those big, wide-ranging price bars closing on their high, or even one like this closing in the middle, we know that there was a lot of activity there compared to a narrow range bar. Right? Very small amount of activity. So range is contracting on a narrow range bar, obviously, and it's expanding on a widespread bar. And we want to pay attention especially to these narrow range bars. And Toby Crable identified a couple of them in his work. And one is what he called NR7s, meaning narrow range 7 bars, which is today is the narrowest range. And again, the range is the difference from the high to the low, right? It's the narrowest range of the last 6 bars. Okay? And this is the narrowest range in the last 6 bars. Statistically, that has a good probability. It doesn't always happen. Okay? And we'll look at a couple of examples where it doesn't happen. It doesn't always happen. But the odds favor an expansion of range. In other words, one of these days here. And what Crable found was that these narrow range days are one of the components of what we would call a trend day. A day that starts on one extreme, maybe starts on its low, and rallies and closes on its high. Or like today in the S&Ps or oil or gold, it starts on its high and goes all the way down and closes on its other extreme end. Okay? So that's why these are so important. When the range contracts down and we see these NR7s, then the odds begin to favor that we're going to see some range expansion and potentially a trend day. Okay? Another way to identify these also is when they are an IDNR4. What does that mean? It's an inside day, but the range is narrowed down, and as a measure, it's the narrowest range of the last 3 bars. So if we had another bar in here like this, then this would be an inside day because it's inside the range of the previous bar, and it's the narrowest of the previous 3 bars, this being the 4th bar. So it's an NR4 day. Okay? Everybody got that? Lars, yeah, that's right. Toby Crable. I'll type in his name here. I think I can do that. First select question. Okay. Is it Toby Crable? Yes. TOBYCRABEL, I believe, is the way he sends it. And I'll send that out to everybody. Did everybody see that? His name there? Just make sure. Brilliant bit of work. Okay, good. All right, so we'll talk about ways to trade this, and we're going to talk about how to combine this with new momentum highs and lows to see if indeed we are getting one of these great days, okay? So here's a bunch of NR7s and IDNR4s. And you can see here's one here. We gap up. This is an inside day, probably the narrowest range of the last 4 bars. We gap up, and we don't get a trend day, but we certainly get more expansion. Okay, here we get one. Don't really have one. Here we get. Here we have one, an inside day, an R4, and we get increased volatility the next day. Another one here, increased volatility. Another one here, increased volatility. Look at this one. This is a nice one. We get a hidden up thrust in here on an NR7. We pop up a hidden up thrust and then come down. This is a trend day where it starts on one extreme, presumably about, maybe it started here, I don't know, but because I don't really look at the open, but you can see that it reached a high and then it went all the way down to an extreme. We have another narrow range day, and volatility picks up the very next day. Same thing here. So you can see that not in every instance do we get, a trend day. It's not 100%. Nothing is. But if we're sitting there the night before and we have an NR7 day or an IDNR4 day, we say to ourselves, okay, what's our game plan for tomorrow? Well, one thing I want to be aware of is that we've contracted in volatility here quite a bit. And when we contract, we know that we can pick up some range expansion, okay? And you can look in the background and you can say, oh, okay, well, I've gotten shortening of the thrust. We've had a little bit of a up thrust in here. We've come down. We've made a lower low. Maybe it's going to come into the downside, right? And so you start to piece that stuff together. And then certainly and I'll show you some examples in a minute, as we're coming down, you'll begin to see that momentum has shifted or come into the market, new momentum. And that's what we're looking for. And these days will allow you, they start to highlight these days. And one of the things you can do is you can, in TradeStation, for example, which is the software that I use, but there's a lot of other softwares out there that I'm sure are good as well. I've just been using TradeStation for a long time, and I'm familiar with it. I have a little program that it's called a paint bar program, and it just measures out the narrowest range of the last 6 days, and if indeed it is a NR7 day, then it paints it, and it makes it very obvious for me. You don't need that, but it makes it pretty obvious. Okay. All right, so let's take a look at this, where we have this range contraction and range expansion, right? When we can see it on a given day, as in one of the daily price bars that we've just been talking about, we can also see it within the day, and sometimes it overlaps the day as well. You can see that we start to rally up here, right? And we push up, and then we get a contracted range, and then we break out of that. Well, here we have new momentum high. Now, it didn't really give us an opportunity to get in, a very good one, on this time frame, whatever it is. But we can see that we do get higher prices from there. Okay, not every one is going to be a picture-perfect opportunity to enter into a trade. But if you can see the direction of the market, that's half the battle, right? So you don't want to be shorting up in here or up in here, because you got new momentum behind you. Allow momentum to come back into the market. The market then goes into a protracted trading range, and we have contraction of range. Okay, we get range contraction in here. The trading range is a contraction. This happens to break out down through the downside. New momentum comes into the market. Places to make trades are here. We get new momentum, and here also, nice little hidden up thrust. You see how you start to combine these things together? Because we have higher prices or lower prices yet to come. Okay? And of course, we do get the shortening of the thrust down here, and seeing that, you would say, okay, I'll take the piece out of the market from in here to in here, and I'll be happy with that. It's not a bad little trade on the this is S&Ps, I think. I'm not sure. No, yeah, this is the S&Ps a little while ago. 825 to a little below 815, so 10 points here, and that's not a bad trade. Okay. So range contraction leads to range expansion, and you can see that on a individual day. Here's one that covers 2.5 days, well, really 3 days. Here you got the last day yesterday, you got the day before yesterday, and notice how this range would be here versus this range. So what we're looking at, this is wider here. What we're looking at most likely is, in fact is an NR7 day here, okay, on this day. And then we open up, we get new momentum low. We can see that in the oscillator. I put this up. You can see here that when range contracts, this oscillator also contracts. Okay? Even though it's an unbounded oscillator, maybe because, in part it is because it's an unbounded oscillator, it does contract, and then it opens up and expands as we start to come down. So, you'd be looking for trades in here and in here. And then we get climactic down here. All right? So range contraction leads to range expansion. Here's one more example. Again, we have a narrow range day here. This day is a fairly narrow range day. It's a NR7 day. It bled over into the afternoon of the previous day. We have contracted range in here. Everything is contracted down. We drive up. We get new momentum high. We pick that up on the oscillator here. And we can look for a trade somewhere in here when it's holding, because higher prices are yet to come. Okay? And then, just to play this out, look at what we get. We get the shortening of the thrust in here. It's telling us, no, we don't want to be going, we don't want to hold on to that long position. The wave structure is changing. We get a larger down wave than we've had here since the breakout. So what are we expecting? We're expecting some pullback of some sort. Okay? Start putting these things together. And here's just recent market. This is actually a couple of months ago, where this is that paint bar. The red are the NR 7 days, the greens are NR 4 days, and the blue is just an inside day. Just different ways to look at this. And you can see how these don't always lead to, but often lead to expanded volatility. All right. Any questions on this? Range expansion, range contraction. Something really useful to get to know. I'm always very aware of when we have a narrow range day and we conclude the day, because tomorrow I'm looking for range expansion. And again, it doesn't always come, or sometimes the next morning will continue to be, I think I had an example here of that. Let's see, maybe it was the first one. Nope, I guess I don't have an example of that. Sorry, I'm jumping around there. I don't mean to do that. But you will sometimes get a couple of these in a row, or the range contraction bleeds over into the next morning. Just be aware of it. Is this like a jump across the creek or a fall through the ice? Yes, very much so. It's another way to say it. It's another way to amplify it for you, so that you can begin to think about it conceptually a little more sophisticated, to begin to understand why this stuff works so well. Wyckoff saw these things just as patterns, but now we can put another layer on it, and we can begin to realize that it is indeed a principle of price behavior, where contraction in volatility leads to an expansion in volatility. And the people who study volatility, people like Larry Connors, for example, he will tell you that volatility is an easier way to measure. It's more cyclical, it's more predictable, I guess is the way he would say it, than price is and price action. So that's something useful to know as well. When it contracts down, it will indeed expand. And you can look at Larry Connors' work. He's got some interesting work on volatility and how that historic volatility and how that works in the market. But that's not really part of this. I'm not going to talk about that too much, because that's going to go off on a tangent, which I don't want to do tonight. All right, any questions on range expansion, range contraction, NR4s, NR 7s, inside days? Any questions about those? All right, seeing none, let's push on. And certainly you are welcome to ask a question if something comes up. But let's shift now into trade setup criteria. And remember, when we were going through the assignment, what we were talking about in terms of piecing together parts of a story to tell, to give us the go-ahead, to flag and highlight and give us the go-ahead to take a trade. All right, so let's begin to formalize that into trade plans, okay? Individual trade plans, or trade setups, I guess I should say. And they're kind of like a mini trading plan. This is not going to be a full-blown trading plan where we're looking at capital and all of that. I'll talk a little bit about that stuff, but we're talking more about chart reading and not about money management and those kinds of things. But there are good sources out there for that, and you should read up on that for sure. So, but you are going to develop a mini trading plan for your trade setups. And that mini trading plan includes speccing out the criteria. What markets are you going to trade this on? And don't be jumping back and forth to, this, that, and the other market. Focus in on a couple, 3 markets maybe at the most, especially if you're just starting out. And you can expand that later on, but you'll begin to learn the little nuances of the markets. Like, I'm much more comfortable, for example, trading the S&Ps than I am trading one of the Forex currencies, one of the cross rates. Definitely more comfortable trading the S&Ps. So you want to know what your markets are. Also, specify your time frames. Don't jump around to 3-minute, 5-minute, 8-minute, 20-minute. Take a couple of time frames and focus on those. You don't need to be jumping in and around all different kinds of time frames. Spec those out and stick with them. Select them and stick with them. Most important thing, of course, is going to be the background conditions, and we started talking about that. Lars asked a question. I've set a limit to 1 market until I master lessons. What do you think about this? I think that's fine. You want to focus and concentrate. And if you are looking at all different kinds of markets, there's a plus to doing that. And the plus is that you see the same things in all the different markets, and you begin to really feel confident that different markets across different time frames show the same basic patterns that we're discussing here. And so that builds some confidence. Yet each one of those markets is going to be a little bit nuanced and a little bit different. And I've tried to show you in many of the examples that we do just different markets because people come in from all over the globe, in fact, and trading different markets. Some markets they trade I've never even seen, or I should say I've never seen live, like palm oil out in the Malaysian markets. It's a big market, and I've had several traders in here who trade palm oil, but I've never seen that, and yet this stuff works in a different, if you think about that, Wyckoff was an American, a Western individual, comes from a Western culture, looking at Western markets, and the same things work equally well in Eastern markets. It's because it's all about human behavior more so than anything. In any event, what we want to do, though, there is a plus to looking at different markets, but focus in on the ones that you want to trade, and add to that slowly. Add one market at a time. Most of the good Wyckoff traders that I'm familiar with would just, if they're trading stocks, they trade a half a dozen stocks, maybe a dozen at the most. Others will trade 3 or 4 different commodities, but not more than that, usually, unless something really, spectacular is setting up, or potentially spectacular is setting up on higher time frames. Anyway, so that's the idea on market. Background conditions, we've talked about that. In almost every session, I would think we did talk about it in every session. You want to tell that story. Here's something that people don't think about too often, but no permission to trade. And we'll look at a couple of examples and what I mean by that. But it's exactly that. I don't have the go-ahead. I don't have the green light. Excuse me. Because certain things are happening or not happening, and I don't want to go in and take a trade when this occurs, and we'll talk about some of those things. You want to know what your entry parameters are. What is it that's going to trigger you in to an entry? You want to specify this up front, along with your protection, risk criteria, your stop, where you're going to set your stop, and your risk criteria, your profit target, and your trade management. In fact, all of these things the more you can specify up front, the less you have to think about in the heat of the moment. So And it doesn't mean that you can only have one criterion. You can have a couple of different things. Background conditions are not going to be fixed necessarily, but they're going to be more. They might be a little more variable. In other words, if we're looking for a sign of weakness in the background, that can be shortening of the thrust, larger down wave, change in wave structure, the biggest down bar since the rally began. There's a number of different things that you can put together here. And you don't have to necessarily have all of them, but you do want to have a couple of them. But anyway, entry parameters. Know what your entry is going to be. Is it going to be a hidden test-like bar? Is it going to be just a test of support? Are you going to buy it on that support test? Or is there going to be other things? Same thing with your stop. Have that fixed. And your risk criteria. I'll talk a little bit about that when we get into the examples. Same thing with profit target. Have a profit target. And we'll talk a little bit. I don't want to get too much into this, but we'll talk a little bit about scaling out of a position as well. Trade management. What would make you take that trade off? Or conversely, if you want to add to your trade, what would give you that? And then you want to start keeping some statistics. I just put win rate in here. What you really want to know is your expectancy here. You do want to know your win rate, the percent win. So in other words, if you win this 6 out of 10 times, on average of over say 100 trades, that 60 are winners and 40 are losers, then you have a 60% win rate. That's helpful, but in terms of knowing that there's definitely going to be a large number of trades that don't win, but more importantly, you want to know what's your average win on these 60 when you do win, and what's your average loss on these 60 that do create a loss. And hopefully this number is going to be smaller than this number, and maybe this is say 2.5 times this number here. So for every dollar you risk, no matter whether it's a winning trade or a losing trade, your expectancy is that you will be winning $2.50 over time. So the law of large numbers, which is the way you need to be thinking about this, this is where you begin to not worry so much about whether it's going to be a winner or a loser, but when this trade setup comes up and you have an expectancy of 2.5 to 1, then you want that trade and you pull that trigger, okay? When it sets up properly. All right, and then build a chart library around this. Put all numerous charts in there, and study them well so that you have a good sense of what goes into these trade setups. All right. Ronald asks a question: What time frames do most traders trade on? Ronald, that kind of depends on a whole measure of things. Day traders will typically use a 5-minute chart. If you're watching the market during the course of the day, the standard is a 5-minute chart. Going down much below that, like some people try to do it off of a 1-minute chart, but I think that's suicidal for the most part, because unless you're really experienced with it, that small of a time frame, things look like they're happening, and they're only on a 1-minute chart, so they're not really. So it seduces you in much more than what you want. And sometimes people go into tick charts, like 250 ticks or something like that, which is even smaller than a minute chart. So no worries, Walter. You've got the flu. I'm catching something. I've got a scratchy throat, so I can empathize with that. Get well then, Walter. Take care. Walter says he's got to sign off. If you're trading, though, Ronald, on a swing basis, then you're going to be looking more at a daily and an hourly chart rather than a smaller time frame. And there you're trying to maybe take the swing out of the week or when something sets up nicely, maybe a little bit bigger than that, maybe a couple of weeks. So you'd be looking on a larger time frame. And then position traders might be looking at weekly and even monthly charts. Probably weekly, where they would look on a weekly for entry. And you can, refine that more and more. If you're a position trader, you're looking for getting in to pick up the, sort of a move that might happen once or twice a year, then you can certainly go down to a daily chart, but your main time frame is going to be looking at monthly and weekly. Okay? All right. So I sent you this format, and it's the same criteria that we just discussed: the name, the markets and time frame, permission to trade, background conditions, what your setup criteria is going to be, your entry, how you're going to protect it, where your profit or exit is going to be, how you're going to manage it, and then your statistics that are important to you. Okay? So I'm going to talk about 2 trade setups tonight, 2 that are pretty much my bread and butter, meaning that I trade these all the time and like them all the time. And they're just very good trades. So one is the up thrust, and I'll show you 2 variations on that. And the other trade setup that we're going to talk about is the spring. Okay, so you'll have 2 good solid trade setups for yourself, and part of the assignment this week is to encourage you to take David Weiss's conceptual map of the market, take the signs of weakness and signs of strength that we've discussed, take some of the exercises that we've done, and start making your own trade setups, okay? And specifying those out. A bit of work, I know, but it's very useful to do. Okay, so here's an upthrust here. This is the SPY, the SPY, which is the equivalent of the S&P 500. It's the ETF for that. And a few things are happening here. You know the upthrust, right, where we have a resistance level in the background over here, and we rally up and try to poke above it, can't do it, and we come back down again and close underneath of that. Okay, but some of the things that go into this is that we are seeing shortening of the thrust over here. Some weakness is coming in on this resistance. We have a bigger down wave than we've seen before, so larger wave down, right? We see a bit of supply coming in here, whole bunch of stuff going into this, right, that you want to begin to think about in terms of the story or background to this. This just becomes the trigger here. Okay, that just becomes the trigger. And so here's what happens with that. Here's our trigger. We enter in. You may want to trigger it elsewhere on no demands, like in here. For example, you may want to put, buy in here or sell in here instead. Or you may wait until it makes a lower low and it's got an upthrust in the background, and then we get a hidden upthrust in here, something like that. You can do it that way as well. There's different ways of doing this. Here's another one where this is FXI, the China market. We see shortening of the thrust, a little bit of rounding over, an inability to rally up for several bars here, a different kind of sign of weakness, but it's certainly a sign of weakness. A lower low gets put in, the wave structure certainly changes here, right? And we rally up, and after 2 days we can't get higher, and we close on a gap down. Now, many people wouldn't want to sell that, but let's take a look and see what happens. If that's your criterion for this trade setup, that it must close, and it is a criterion for an upthrust. Otherwise, you don't know if this is going to just sit up here and absorb and then go higher, or if it's going to come down through. The upthrust, to be valid, must close underneath the resistance level here, and that's what's occurring here, and then it continues to go on down. Okay, you've seen these before, well, not these examples, but you've seen the upthrust. Here's an example, one I like to show because I think it's very powerful. and that is the Goldman Sachs chart here on a weekly basis. This is a weekly Goldman Sachs. And we can see, again, certainly the wave structure has changed. I mean, you can't miss that on this chart, on a weekly chart. We see volume coming in. This is supply over demand here, right? That we were talking about earlier tonight. Even here, we see bigger volume coming down, and the biggest volume in the uptrend on a down bar. And we see, this waves. Excuse me. We see the wave structure change in terms of the buy waves shorten here, and then the down waves lengthen. So here we come up, and you might have thought, here's the upthrust here, and since this is a weekly chart, hopefully you would be either using a very large stop, or if you were trading off of that and have very large accounts, or you are dropping down to a daily chart and looking for a good entry. So that's a mix of time frames there. But we have that upthrust occur here, and it closes decisively underneath. And let's see what happens with this. That is this bar here, and this is 2008 in here, up here, or 2007 maybe. 2008. I apologize for that. 2008. And here we are in 2009, and this triggered the bear market, where Goldman Sachs went from just under 250 here down to 50 and lost 200 points or 190 points. Now, I'm not suggesting that you would have gotten all of this by trading this, but you can see the power behind a weekly upthrust when they occur. Okay? Here's one on a 5-minute S&P chart. Okay? We have this is the Globex high over here, and we have resistance occur. The wave structure certainly changes. We've got down waves here. Now look at this. This is pretty interesting. It looks at one, if we're just looking at the bars here and reading those, at one we get a good move up and some pretty good volume. Even better on bar number 2. Looks like there's buying coming into this market. But then look what happens on bar 3. What's that, everybody? What happens here? Excuse me, I had to blow my nose. Yeah, no follow through, no demand. Suddenly demand just disappears, and we rally up, and we see big volume come in, and the close is where? It's underneath resistance, underneath the overnight low. So we have an upthrust here. And let's see what happens with this. Here's that bar. And here we have another no demand on bar 4. No ability to rally up. It gets tested here on another, I would call this or consider this to be more of a hidden upthrust. We don't get a big wave down here, but still it's, still a hidden upthrust. And for sure, this is a nice trade, and supply comes in, and then we're down here. So again, the background is important, okay? And we can see it in, I'm showing you different ways of seeing the background and different ways of reading the edge of the chart to see that it's confirming that. And even when, in that example, when it wasn't clear, I remember that trade actually, believe it or not. It's a few years ago, and I remember thinking, oh, it's going to rally through, and then it doesn't. And it was the telltale was that no demand. You don't see that on, as a market is trying to push through. So, okay, here's another example of an upthrust. This is a variation. Here we're in a good downtrend, then the market goes sideways a little bit, and then upthrusts that sideways action. Some of you might call it a hidden upthrust. That's okay too. Again, I don't really care what you call these things as long as you recognize. Notice here we have range contraction, right? Now this is a 5-minute chart. So this is range contraction here. We drop out. So new momentum to the downside, right? New momentum coming into the downside. We can certainly see that in the price bars and the volume. Yes, certainly there's some buying coming in here, and then it doesn't go down any lower, and there's some buying here as well. But boy, this stage is set for momentum. And on the rally up, do we see any kind of big price bars like we see here? No. What we see is a sort of a choppy rally up on a 5-minute basis, coming into supply, the known supply area to the left. This would be, for those of you who think in these terms, this would be ice here, right? Or pushing through the support, range contraction, range expansion. We have, supply in the background, weakness in the background. We rally up, and here we have an upthrust here, sort of a secondary upthrust, right? But that supply, that background of weakness is quite evident. And here we are. Here's what happens with that. And this is where we were. It looks like this happened at the end of a day, and then the next day, trend day down, right? Not a surprise. What about markets falling faster than rallying? Lars, I'm not sure what you mean. Typically they do. Most all markets will fall a little faster than they rally, though not always. But you mean as opposed to this is falling faster and this is rallying, and because things fall faster we should discount this? That I would not agree with. Just look at these price bars, look at these price bars, and then look at these price bars. You have to say that supply is in control. Sellers are pushing this market down. Okay? There's emotions that go into supply. Most people are buyers of a market. They want to see the market rally. They feel better when the market's going higher. They don't feel so good when it's going down. And so when the market does go down, there are probably fewer traders. This is probably less true today than it was back in the day, so to speak. But people panic and they jump out real quick. Could this be deceiving, meaning that a market going up on narrower bars could still be going up? Could that be deceiving? Not in this case, where you've got a narrow range and you're breaking down and you got new momentum. Okay? If we were at the bottom of a long trend channel and we have the big volume coming in and we've got wide spreads coming in, then I would say, yeah, you could see this kind of going up, sideways to up for quite a while. And there's still strength in the market because we have had a climactic action. But, you have to look at the structure of the market. Climax is very different than new momentum lows. Okay? A selling climax is very different than new momentum lows. Selling climaxes occur at the end of a trend. We've been coming down and down and down, and then finally it gets oversold in the trend channel, and we're down here. This new momentum low is because we're starting up here and we're just breaking down out of this trend channel here, and now we have new momentum lows. We want to sell that first pullback. This is the best trade I know. Bar none, the best trade that I know. And this is just a variation on that trade. Okay. All right. Meaning comparing ranges. Well, I'm giving you the structure here, Lars. That you have to think this through. Okay. Think it through. It's not about necessarily comparing ranges, because these are small and it's going to continue to go up. These may be small and it will go up because it's down here, but it's not going to go up over here if this is the structure of the market. Okay. All right. Hopefully that addresses it. Okay. Good. It does. Good. All right. How about this upthrust here? What do you think about this? We get this high volume in here. You know, high volume can mean supply, and we get this upthrust bar here. How many of you would take this and how many would not take this? Let me get some answers here. Let me get some, say, sell or sit on your hands. You would have sold, okay? And you would have sold, okay? No way would I sell that thing. Well, looks like it just broke out a consolidation, okay? Not a strong trade. All right, so it's about 50-50. All right, let's see what happens, and then let's talk about why. Here's where we were, and there's where we are, okay? What's going on? Let's go back to this other chart. I want you to be clear on this, because I see this all the time. This is the big problem with people trying to trade upthrust. What is the background telling us? What's the structure here? What's the background? Uptrend. How do we know it's an uptrend? We've talked numerous times about this. How do we know this is an uptrend? This is a strong uptrend. How do we know it's a strong uptrend? Higher highs and higher lows. Okay, we have a low. We have a high. We have a higher low. We have a higher high. Higher low. Higher high. Higher low. Higher high. Higher low. Gee, do I want to stand in front of that? I don't think so. Okay? That's one. Another is wave structure. Up, down, up, down, up, down. Up waves are bigger than down waves. And the last one has been bigger than the previous up wave. Okay? It's saying that there's still momentum in that market. When we are in an uptrend, we will see this all the time. This is most likely just a little absorption, meaning that people are taking profits probably. Maybe there's some people in there who are shorting against this, thinking that this is indeed an upthrust, but they're wrong, of course. When we're in an uptrend, the odds of trading an upthrust and being successful with it are really not a good idea. Okay? If you remember, and if you don't remember, go back and re-listen to the video or review your notes. We were looking for weakness in here or in here, meaning that we were looking for shortening of the thrust, we were looking for biggest down bar on largest volume since the rally began, we were looking for a change in the wave structure, and so on and so forth. Okay? We were looking for weakness here. But here we don't have that. We have nothing but strength in this chart. We see this all the time. All the time. Just because you have high volume and the bar closes in the middle does not mean that we are going to be... This is not an upthrust here. First of all, the spacing between the two, this resistance level and this this high is too wide. If you're trading off of, this is a daily chart of, looks like Humana. If you're trading this stock off of a 5 or a 15-minute chart and you see this, well, sure, you can trade to the short side on that time frame. You go to trend day to the downside here, but that's on a 5-minute chart. On a daily chart, you know, it's happening all the time where you don't have up thrusts, you don't have up thrusts, you don't have up thrusts. Okay? Make sure you got weakness in that background. That's why we want to tell the story. Yeah, no change of behavior. Exactly right. Look for that change of behavior. Okay, so let's now, we've seen a few examples. We've also seen what not to do. So let's talk about what a trade setup would look like. We call this the Wyckoff up thrust. You can call it the, you know, the red trade or the black trade or my favorite trade. It doesn't matter what you call it. But here we're calling it the up thrust. The markets that we're going to trade, that I trade this on, 5 and 15 minute. If I see it on a 30 or a 60-minute chart, I'll note it and I'll try to take a 5-minute pullback after the momentum gets going to the downside. Okay, but I'm pretty restrictive on my own here about the time frames that I trade. And I would encourage you to do the same, at least while you're still learning this stuff. Don't be jumping around to different time frames. It's an easy way. A 60-minute up thrust is a very different animal than a 5-minute up thrust. Okay? And if you're just starting, you may not be picking them right, and you may be, if you're in a 60-minute chart, you may be, you know, you can't use a 3-point stop on a 60-minute chart in the S&Ps. Well, some people may try to, but I wouldn't recommend it. Okay, remember I said no permission to trade here. So there are certain times when it is maybe not to your advantage to trade. If you're sitting in front of the FOMC market and you see an upthrust occur maybe at noontime, and you know in 2 hours or an hour that the FOMC is going to release, maybe it's not a good time to do that. Okay? Certainly, but this is going to be your call. I'm not prescribing this to you. These are just some examples of, you want to have this in here. You want to have some guidelines for yourself when you don't want to take a trade, okay? Certainly, in a dull, flat market, it may look like you're getting an upthrust, but you don't want that either. And what I didn't put this in, but in an uptrend, okay, without a sign of weakness, you want to include that in here as one of the things that you don't want to take a trade on. And then if you're unable to set an adequate stop, I mean, you may have a beautiful looking up thrust, but your stop is 8 points away from you, and that's too big for your account, so you don't want to, we'll talk a little bit about that in a minute. You don't want to take that trade. So that's I let that go. I pass. Okay? Background conditions. Market's going to be active. We've had an uptrend and an old top forms, but there's a clear sign of weakness, and you can be more specific about this if you want to. Shortening of the thrust, large down bars with large volume. However, weak bars where we see a series of bars closing on their highs or on their lows with good volume coming in. There's different ways of doing that, and you'll refine this over time. Okay, you can refine this over time. So you have a clear sign of weakness, or prices made a lower low. It's that wave structure that we're talking about here. Okay, that's the first type that we talked about. Type 2, market is in a downtrend. Prices rallied, but it's rallied weakly, and it's formed resistance. Okay, and then in both instances, there's a rally to the resistance level, and that rally is generally weak. And we can see that in numerous ways, but in terms of price spread, we saw that on the last example. We also saw that 5-minute chart where there was a little no demand there, and then the upthrust occurred. So there's different ways of seeing that weakness coming in. The setup criteria: price pushes up above resistance, and the higher prices get rejected. It then closes below that resistance, and it happens within 1 to 3 bars. You may find that 5 bars works better for you, or no more than 2 bars. I find this usually is pretty good, 1 to 3 bars for my own trading. Okay. Entry. You can have an aggressive entry or a conservative entry, but just decide what you're going to do and do it. Don't be trying to decide, do I want to make the entry here now or later? on when it's happening. That's going to get you in trouble. You want to have, kind of like, think about it, kind of like if you were going to go play, I don't know, a tennis match. When the ball comes in short, you don't want to be thinking to yourself, am I going to hit it hard, or am I going to lob it, or what am I going to do? You want to be able to know that when you get a short ball, you're going to go for what they call an approach shot down the line. If you're in that position, you don't think about that, because if you're thinking about it, you're not going to be able to hit it. Same thing in trading. You want to know where your entry is. So aggressive is going to be on that close of the upthrust. Conservative might be the first no demand bar, or it might be a test of the upthrust. I didn't put that in here, but that's a possibility too. It's a good possibility for conservative. Now, we don't always get a test on an upthrust, but certainly we do enough times to make it worthwhile. So, what about setting protection? Well, I want to put it here, I say 3/4 of a point above the high of the upthrust. And if I'm taking a no demand, then I want a 1.5 above that. But in no event will I risk greater than 2% of my trading account. And 2%, frankly, is pretty rich. Somewhere between 1 and 2% is a good amount. So, for example, if you have a $10,000 account, then say 1.5%, you're willing to risk $150 on a trade. That would be 3 points. Okay, 2% would be $200. Okay, and so on. You don't want to be betting the farm on any given trade. You want to keep every one of them small. Why? Because we're talking about the law of large numbers. We want to be making money not on every single trade. We want to be making money on over 100 trades and 1,000 trades and 10,000 trades. Okay, so some of them aren't going to work out, others are. That's why we want to keep that risk to a small amount. Profit target. You can do this in a lot of different ways. If we're in an upthrust, it's upthrusting the top of a trading range. The logical profit target is going to be to the bottom of the trading range. Or you might be going for a bigger profit target and you're looking more for a climactic volume or stopping volume to come in. Okay. Trade management. I said we would talk a little bit about scaling out. You can scale out, meaning that you take a piece off when certain events are achieved. And this is just an example. It's not what I recommend, or it's not even what I do. It's just a way to do it. You can scale out on a fixed profit by number of points. So if you're trading, say, 2 contracts, scaling out obviously requires multiple contracts. Or if you're trading, 1,000 shares, then you're taking off half when you reach that event. So 3 points profit, I take off 1 contract, and I move my stop to break even or tighten it up or whatever, and then I look to the bigger profit target to scale out the rest. Okay, and then in the beginning I talked about win rate, and really you ought to have expectancy in here as well. Okay, both your win rate and your expectancy, and I discussed that a little bit. All right. Any questions on the upthrust? You all get the idea here about how to do this. And notice what I'm encouraging you to do. I'm not telling you that I have a statistical program that tells me that this is going to produce 70% winners and an expectancy of 2 to 1. I'm not telling you that at all, because no one can trade and match exactly the what the computer tells you. Okay, you can do the research like that, and that gives you good guidance. But what you need to do is you need to track your own statistics. What we're talking about here is not what the trade produces on a computer, but what you produce off of this given trade. Okay? what you produce off of this given trade. So this is your, it's really not the trade's statistics. These are your metrics on this trade, how you trade this trade, and that's the most important thing. Okay. All right. Any questions on this? I don't see any. So we're going to do the flip side, and that's the spring. My other bread and butter favorite trade, and you all know this one. We come down here and we establish a support level, and then we come back underneath, dip under that, and then rally up above. Okay. So let's take a look at some springs. Here's one that I like to show. This is ISRG of a couple of years ago, where boy oh boy, I remember we talked about this. Sometimes in these trading ranges here, this jump across the creek can occur on a big gap, and I think I said that you can kind of in your mind's eye extend this down and see this as a true range, right, from the close to the low here. And that kind of gives you a sense of what has really happened here on something like this. Okay, so now we come up here, and you know, most people would say, oh gee, I could have bought it when it was $140 a share. Now it's, oh man, now it's $60 more. It's $200 a share, or more than that, $15 a share. I'm going to pass it by. Well, don't let your mind get in your way here. This is a spring. It's a bona fide setup. It's a great setup because what are we seeing? Big strength in the background, right? And this is huge strength here. New momentum highs. Higher prices yet to come. Okay? And we're also seeing a little range contraction on a bigger time frame here. So what happens? Let's see. There we go. We rally up, and not only do we rally up, we produce another spring, and there's another one where we can take. So instead of saying, "Oh, gee, I could have bought it at 140," so you buy it at 220, and you're 40 points higher up here. Okay, giving you a little psychology as we go along. Here's one. We're in a good little uptrend. Making higher highs, higher lows. We kind of just broke out from this area here. Nice absorption that went on in here, and so on and so forth. This was actually a spring that we took. This came up one time when I was teaching this. I think the first time I was teaching this course, I said, here's a spring on APA, Apache Corp. Let's take this. And here's the result of that. Very nice. Very nice result. Okay. And you can see in here that there's good wave structure, right? Big up wave, big up wave, big up wave, all bigger than the down wave. This one got a little bit larger, but notice it's not breaking down to new lows here. This is nice. Anybody notice other springs on this chart? Where do you see them? One in September, yep, one right here, and also one here in October. This is a nice chart. This is a nice market for, one with the absorption, a nice market for springs. Okay? And this is not uncommon, where you will see, this is why David Weiss will say, if you traded nothing but springs and upthrusts, you could do well. And it's really true. You can do well just trading these things alone and doing nothing else. Here's one that I like to also bring out. This is a daily chart, and now you're going to say to me, "Oh, Gary, you're in a downtrend, right?" Well, when you get good at when you start to get used to this, let's look at this. This is the result of that. Let me go back up so you're clear on this. You can see where we are here on the edge of the chart, around $16 a share, and we're over here, right? And that is the same level here. Here it is, 16 a share. It's this bar right here, okay? And this is the spring. Now, notice we come down to support. That's certainly one thing to notice. But another thing to notice is that we have a pretty good drop. We drop a little bit lower, but here we break the downtrend channel, right? The downtrend line gets broken. And also, if we drew this in, we would have shortening of the thrust in here as well. So there's a story here, even though we're coming down. There's a good story. And look at the response we get from that spring. Very nice. Okay. And here's just another one on RIM, one of the popular stocks a couple of years ago. Again, you can see the same principles here. These are this is a 15-minute chart of RIM, research in motion. You can see the narrow range days in here, right? And the range contraction in here. We get a spring, and what happens? We get a trend day coming out of that, right? And it continues on up. New momentum produces higher prices. Okay? A lot of times if you're trading the S&Ps, you'll get, here's the early morning here. This is probably, this is 9:30. This is just after the open. So the open is right in here, okay? And this is a tick chart, so it's maybe a little different. But you can see again that similar to the last chart, and this is on a smaller time frame, that we have come down and we've broken the downtrend channel, meaning that the up waves now are increasing, right? It's another way of thinking about it. And then we come down, we don't go and come down to where we would expect, and now we have in this is the overnight low here, and we come down and spring that and then start to rally up from there. We spring here and test it here. And just like the up thrust, you can wait for a test if you want. Okay? And then everything shifts, and now we're moving forward to higher highs and higher lows. Do I take springs and upthrusts on tick charts or only time charts? No, tick charts as well. All the time on tick charts. My main charts are tick charts when I'm trading the S&Ps. Okay, similar then with the spring setup. It's called the Wyckoff spring. You can call it what you like. In this instance, I said S&P E-minis on a 3 and a 5 minute basis. Equities coming in, and you can be specific here, the S&P 500, the NASDAQ 100, the IBD 100, certain stocks there, on a daily basis. Okay, Ronald, this gets to your question about, time frames. It can be, depends on what you want to do here. Again, no permission to trade not near economic news. Certainly in dull, flat markets, you don't want to do that. And clear downtrending markets. You want to be very cautious about taking springs and downtrends, upthrusts and uptrends. We want to see in our background active market, a good defined uptrend, as we saw in APA, or clear indications of buying that occurred down at the last swing low, which we saw on the break of the downtrend channel. Support level is nicely defined for us, and the reaction to support shows supply is weak. And typically we'll see lower volume coming in on the down move into support. That's not always the case, but for people who are just starting out, that's a good idea. Okay. Setup criteria: price dips down below support, lower prices get rejected. The volume on the dip down below support is clearly less than the volume at the last swing low. That's a good little indicator for somebody just learning this trade setup. That being said, you will see springs which have higher volume on the dip down below support than the last swing low that establishes support. And you'll begin to realize that this lower volume is okay maybe, but for most springs, but sometimes we're going to see a good spring and it's going to be on high volume, and we're going to want to get in on that too. But let your experience guide you on that, okay? Let your experience guide you on that. My recommendation or suggestion would be to stay with the low volume swings down to begin with, and as you get more experience, you can tackle the higher volume ones as well. And then, of course, price dips down and then closes back up above support. Sometimes you'll see it tested at the support level. That's okay too, but this is always the best, when it just dips underneath and rallies up instead of spending much time down below there. Okay? Aggressive entry on the close above support. Conservative on the first test or no supply indication after the close above the support level. That's good as well, but we don't always get that, as we've seen. Then specify your protection. Where are you going to put your stop? A half a point below the low of the spring, a point below the low of the spring in equities. Again, don't risk too much on this, and that's going to be a function of your current account size. Meaning that as you get more experience and you grow your account, you can take more risk, can take on more risk, more contracts, bigger stops, whatever. The next and then profit target is the same thing, either next significant resistance level, climax, or other significant sign of weakness. Trade management, here's a little bit different. I told you a little bit about scaling out. You can do that here if you want to. What I wanted to just highlight in this is just another piece of trade management. It's more a function of chart reading. If that spring is hugging that support or the lows and failing to rally, so we've sprung, so we've come down, we have that support here. I'll use this line. We've had the support, we rally up a bit, we come back down, we dip underneath, here's our support line, we come back up, but now it's just hanging here and not doing anything for 3, 4, 5 bars. And I don't know the number, there's no set number, but it's not able to lift off. We should see, especially if we test down in here, we should see that thing rocket right off. If it's not doing that, it's known as hugging the lows. It is not rallying away from the danger point being the lows here. So you want to get out of that, okay? You want to get out of that. On the up thrust, just to make this a little bit more clear, if the market comes up and up thrusts here and then just hangs here, remember I said absorption is the thing that we have to watch out for. It could be absorbing and then rally up from there. So you might want to add that to your trade setup as well. And then have your statistics in there. And again, expectancy is important. Trevor says that seems to be the case in the S&Ps today. On the intraday time frame? On the end of the day, you mean? There was a little spring at the end of the day? Yeah, well, we had a trend day down. Nothing broke. No trend lines broke. I saw that as well. I guess the trend line did, but a trend day down, I wouldn't be trying to buy a spring that occurred. I think that occurred around 3:30 in the afternoon. Not likely we're going to see much lift on that. Here's a bunch of springs and up thrusts from a series of intraday charts. You see them. I'm just doing this to show you that you see them all the time. And you can start to pair things. Here's a bottom reversal. We see here at A. This looks like a 10-minute chart I used here. We gap up. We have a little bit of weakness come in, but we don't see much of the market push down here. We don't see volume really coming in, expanding to the downside. We see at A, we have a little buying coming in, and then we are in an uptrend here from the yesterday afternoon, and we get that bottom reversal. It kind of goes sideways here. This is not really hugging the lows. It's just hanging up here. The volume is not increasing. We get testing. It rallies up, puts in a higher high. That's nice. Tests again on low volume, rallies up, and there it goes all the way through into the close. So we get a nice trend day from that, or almost trend day. Okay. Next day, buyers have probably spent their wad buying throughout here, and we see a little up thrust occur. Look at this weak rally, just saying that there's nothing behind this market. All right, nothing behind this market. And we also see, compared to this day here, that we get a good size down wave, shortening of the thrust, all those things. We get a little up thrust, and the target, I like the target of the previous support level. Then we get a spring here, because we still are in an uptrend, and maybe this is just a little bit of a bigger trading range. It gets tested, but it doesn't give us much. We don't get that liftoff that we should see, and we start to come back down. We start to see supply, so we want to get out of that trade here. Okay, they don't always work. That's why we want to keep statistics on these. Here's where we ended this day on the last chart. We have that spring and the test, and it kind of fails. It doesn't really give us much. We're not able to push up above the previous swing high here, which is a small one, but still we should really be pushing up above here. And so now we come down. We can draw a trend channel in. We can see that we're not getting all the way down to the trend channel. We get shortening of the thrust. This is the following day. We try to go down. It rallies up. We test it. Tough one to buy probably, but it's still a nice little spring. The wave structure does change a little bit here. No, not really. I take that back. But it is a spring nevertheless. We rally up. Now we get a spring in here. It comes back down and still holds, and then we get kind of caught up in the noon hour. So we don't get a whole lot. We get a little bit, but not a whole lot. We rally up, higher highs, higher lows, make a spring, and there we go, up again. So we see them frequently on the intraday charts. Just make sure you're in a good day to take them, and try not to be fading a trend day to the downside like today was. Here's the recent market in terms of up thrusts and I don't know why I say TR there. It should be up thrusts and springs. That's a mistake, sorry. This was the last high we had back in May, and we come down. We make a lower low here. You know, the wave structure is clearly larger. And then we rally up on this level. We up thrust that level. When we come down, we test it, and then we come down. All right? We get a little climactic here. We have another up thrust. This is still a pretty good one, though it doesn't give us all that much. It doesn't give us a new leg down, but it does give us a little bit. And it was a good one for day trading purposes. Now, a couple of months have gone by here. We come down, we spring. This was the last low we've made in September of this year, and then we rally up from there. So this is a daily chart of the S&P. So you can see that we were doing a 10-minute chart and a daily chart. Clearly they're going to occur more often or more frequently on the 10-minute chart than they will on the daily chart, but it's important to recognize both of them and know when both are occurring. If you're trading the intraday, you want to pay attention to the daily as well. And look at the nice response from this spring here. We don't always get it like this. Sometimes it tests, and sometimes, as you have seen, they don't work out. But sometimes they just take right off. Here, on the up thrust, this did not just come straight down. We'd all like that, to have that instant gratification, but in fact it had to be tested first, and then it came down. You can also see the idea behind range contraction. We're in this contracted range, and range expansion here, right? And also here, range contraction leading to range expansion. It's cyclical, and it happens all the time across all different time frames. All right, any questions on the spring? I mean, you've seen this before, so this is to highlight this in a little bit more detail and to also show you how to formulate trade setups for both springs and upthrusts. So the suggested assignment this week is to look at the markets you trade and identify inside days and NR narrow range days, and look for that range contraction and observe what happens after the market leaves that range. Okay, and it's fun to find a inside day or a narrow range day on a daily chart, and then look at it on an intraday chart, and then look at how it trades the next day. It's especially good for day traders out there. And then develop at least one. You can develop as many as you want, but you should have a half a dozen trade setups, and there's plenty of ideas that we can look at here. And I'm giving you a spring and upthrust as two specific trade setups that I take all the time. But I'm not giving you other specific things because I want you to work on these and make them your own. That's the hallmark of any professional, is that they take what others have written, they've taken their own research and so on and so forth, and they put it into their own take on the market, their own personal. If you have 4 trade setups to the long side and 4 trade setups to the downside that are your personal trade setups that you've crafted out of whole cloth here, using the information that I've conveyed to you, and you've gone back and you've looked at those. We're going to talk about how to get good at this next week. You go back and you look at those and you refine your trade setups until you've got them to the point where you've got pretty good ones, that they're hitting pretty good, percent return and giving a good return for the risk, good expectancy on the risk that you take for each one of those trades. You got 4 or 5 of those, 3 or 4 or 5 of those. You got something. Now you're a trader. Now you got something you can work with. Ron says, I refer to hidden upthrust but not hidden springs. Any reason? You know what the real reason is? Truthfully, it's because Tom Williams doesn't recognize springs. He doesn't think about them at all, doesn't use them at all in his trading. And he does the upthrust, and some of the, we differ on a few things, and that's one of the things that we differ on. And he was the one who came up with the idea of hidden upthrust. I suppose there are hidden springs, but I just consider them as springs, just in general. But that's the real reason. So develop a trade setup. Take a sign of strength or a sign of weakness. Clarify the structure and background conditions. Go to that conceptual map of the market and use this. This is now an opportunity for you to really sit down and think. Remember, I said work with this map that David Weiss was so gracious in giving us. Use this and really get to understand it. I think it's really helpful to have a conceptual map for your trade setup. I gave you 2 examples with the upthrust and the spring. So do that. And then show a couple of chart examples and highlight where the strength comes in, where the weakness comes in the background. Really focus in on the structure and the background conditions and make sure that they're going to support your trade setup. That's the whole idea here, is to get you. That's where chart reading mastery really comes into play. It's in this area here, being able to see this. And then you have the trade setups already thought out, and it's not a big deal to take them. Okay, because you got this, you're leaning against structure, and that's what you want to do. And then specify all the criteria out in the suggested format. How many trade setups do I use? Fewer than you would expect, Ronald. Just probably a half a dozen. I look at my trade setups and I've winnowed them all down now to the point where I've got just a few, really, that I look for. You don't need many. You really don't. Okay, so some possibilities to consider in developing your trade setups, or if there's something that you know, develop your own. That's great. We've talked about new momentum highs and new momentum lows. There's something to work with, right? Because it's a principle of price behavior that new prices, either higher or lower, are yet to follow once we see that momentum. Gee, that's a nice trade setup. The day following an NR7 or an inside NR4 day. We talked about that today. It's very similar. You can combine these two now and make it even stronger, right? 3 pushes. Add some other weakness in the background, like being oversold or overbought in the trend channel. Just some ideas here, okay? Shell Divers Tragedy, that's a trade setup in and of its own right. I went into some detail about that and talked about the weakness that's coming into the market that creates the tragedy in the diver, that causes the diver to drown, right? Weakness is inherent in that story. A test in a rising market or no demand in a falling market. In deep practice lately, we've been looking at the currencies, and we see a lot of days where there's tests in a rising market and no demand in a falling market. We covered that here, but we really had talked quite a bit about it and ways to trade it in the deep practice sessions. So if any of you are in deep practice, you know that's a nice little indication when we've got a good grinding market operating. And sometimes in a grinding market, it's really hard to find an entry, especially if you're trading on a daily basis or a 60-minute chart or something like that. Sometimes it's not letting you in when it's really strong. It's low volatility, grinding market, hard to enter. Well, the no demands, if it's falling, and the tests in a rising market, if it's running up, are useful ways of getting into that market. If that's your cup of tea, if that's, especially if you're trading the currencies, which have a tendency to trend, and they trend in a grinding way. For those of you who have more internal fortitude and bravery, testing of climaxes or no demands after a buying climax. Now, you don't have to take the first one. It can be you get that selling climax occur, and it can be a range of tests that occur. But it is a little more fortitude than something a little bit different. So, for example, let's say we have a selling climax, and you know yourself well enough, like me, you're not willing to try to buy the lows. Then you wait for that push up through, or that jump across the creek, push up through supply, and then the back up to the edge of the creek. So your trade setup may be some sort of a selling climax or a stopping volume in here, and a trading range ensues, and then we have a sign of strength here with good volume coming in, and good price spreads or ranges coming in on the price bars rallying up, and that all goes into your trade setup called back up to the edge of the creek, or the testing afterwards, whatever you want to call it. Okay, and that would be the weak rally after the push through support, or the weak reaction after the push through resistance. But a nice way of combining a number of indications of signs of strength and signs of weakness. And if you're trading stocks on a daily basis, there's a good setup for you. Okay, doesn't happen all that much, but if you're looking at, a lot of stocks every night or every week or every month, I should say, then that's a good one to think about. But of course, it happens on all different time frames, so you could see that if you're swing trading stocks as well. You'll see this a lot on the 60-minute chart. Weak reaction in an uptrending market, weak rally in a downtrending market. We're going up in a nice trending market, and these pullbacks here, we have wave structure to lean against, we have light volume, we have narrow spreads, and then, there's your trade. bottom reversal at support, top reversal at resistance, similar to the up thrust in the spring, just a little bit different. Kind of look at that. All right, so there's some suggestions, and there's more. There's a lot more that we have here in the course that we went through. But those are some suggestions. So put together 1 or 2 trade setups, and I can evaluate them for you and critique them if you like. And again, try to do that conceptual map and show a couple of examples, and be sure to specify out that criteria in either the suggested format or a format that you would like to. And the reason, by the way, for the conceptual map is so that you think it through. You really want to think it through. Where would you find support? Where would you find resistance? All right? All right, that's what I have for you this week. Next week, we will wrap up. So again, any questions, we will look at a series of trade setups that you will put together, assuming you're willing to share them with others. And we will also talk about how to get good at this stuff, and any other things any questions, clarify any questions that you might have remaining from the course. All right? And so we bring session 7 to a close. I want to thank you for coming in, and I will see you next week. Have a great trading week and a great week in general, and I'll see you next week. Take care now. Bye-bye.